little experiment at home, and it tends to be rather controversial. When I wrote my columns in the Financial Times, it's something I've referred to in all those books you see over my shoulder, and it tends to drive people skits, and usually because people are already invested through fund managers and have hundreds of stocks, and if you try and talk them out of it, they don't like it. The effect of diversification on risk reduction of your portfolio. So the risk, for risk, read volatility around a certain return. And what tends to happen is there's diminishing marginal returns of adding more stocks, and that marginal return diminishes a lot quicker than people realize. At which point people say, yes, but surely it depends upon the correlation of the individual stocks. Of course it does. What people don't realize is the time you want correlation or lack of correlation, i.e. diversification, is when the markets are falling. Of course, if the markets are rising, who needs diversification? You just want all your eggs in one basket if they're rising because you want to maximize your returns. So you need diversification and lack of correlation when the markets are falling. Again, research and data shows that actually when the markets fall, correlation increases across sectors, across geographies, and across every single category of stock you can imagine. Another way, when the markets tank and you need diversification the most, you're least likely to get it. Or in simple language, when COVID happened, Microsoft and Costco both fell. Chinese companies and US ones both fell. Okay. So the correlation you think you're getting by just randomly picking different sectors is often not as great as you believe it to be because you've not looked at the data. Equally, geographic correlation sometimes will give you a lack of connection, say to US stocks, if that's the sum total of stocks you've got, but it'll give you it at the price of performance. So when the markets are going up, those other ones aren't. So you think, great, I'm diversified. Actually, you're underperforming compared to what you could have done. So have a look at this and try the experiment. Pick 15 stocks from completely different sectors and then pick 100 stocks and see what happens.